Good afternoon and welcome to the Westmount Wealth Q4 2022 commentary. My name is Lorenzo Pederzani.
And I'm Matthew Evans.
And we're the two portfolio managers on the team. We're going to talk today about what was a difficult year for investors last year and give us your thoughts on 2023. As always, we like to start off with a little bit of a quote to reflect the mood of the times. And today's quote comes from famed economist John Maynard Keynes, who said, "It's better to be roughly right than precisely wrong." And I think that's an important thing to remember when we're seeing difficult times in the market. Sometimes people like to make concentrated bets or timing calls. At the end of the day, owning the market, staying invested is the key. And I think really that was the tale of last year. So let's get into things. Let's talk about what happened last year. The headline all year was inflation. We saw it starting to rear its head early in the year, and in response, central banks around the world started to raise interest rates at a very fast rate, a rate that we haven't seen in decades, to try and cool the economy off. Let's take a little bit of a look at the data. So after almost 30 years of inflation hovering between 1% to 3%, both the US and Canada saw a huge spike in inflation last year. We saw global supply chains obviously affected with COVID. We saw global supply chains affected with Russia's invasion of the Ukraine. And of course, as the world started to ease out of COVID, we started to see consumer demand surging. All of that led to a big surge in food and energy prices, the cost of goods, and of course, the cost of services. In response, as we mentioned, central banks very aggressively raised rates, going from 0.25% as an overnight lending rate in both Canada and the US to over 4% in both countries. We haven't seen rate hikes like that in decades. And correspondingly, what we saw was consumer confidence plummeting in response, and more and more talk about recession. When we take a look at consumer confidence in the US, the University of Michigan has been running these consumer confidence surveys since the early 70s. And interestingly enough, at the middle of last year, we saw consumer sentiment hit its lowest point in effectively 50 years, which I find quite surprising because it's lower than even the consumer sentiment during 2008, which was the great financial crisis, which in my mind seemed like a much more extraordinary, event in the markets. Nonetheless, the talk growing over the last 6 months has been all about recession. Interestingly enough, we're seeing, if you take a look at the last 50 years, if you take a look at professional forecasters in the US, almost half of them now estimate that a recession is coming, in the next year. So whether or not that manifests in the US or in Canada remains to be seen, but it's certainly on people's minds. So let's take a look in detail about how each asset class performed. Matt, can you walk us through it?
If we take a look at first the bond markets, it was a very ugly year. If we're looking at the FTSE Canadian Bond Index, it finished down 11.69%. The US Aggregate Bond Index down 13.01%, and the global bond aggregate finishing down 9.12%. Now that might not sound that surprising to you, but when we look at it in the context of historical return for bonds, it was one of the worst performing years in history. That being before only a -3 posted in 1994 if we're just looking at the US bond ag. So really an outlier in returns and really a function of that central bank policy. As interest rates move higher, bond prices typically move lower. When we look then to the stock markets, it was also a very terrible year, with the TSX Composite finishing down 5.75, the US S&P 500 finishing down 18.13, and the more growth-oriented NASDAQ, which has been a very strong performer over the last few years, finishing down a whopping 32.51%. And international equities measured by the MSCI EAFE index finishing down 7.92. So really nowhere to hide as an investor last year. So when you put that together and you look at a balanced investor who's going to invest in bonds, and we're going to use a proxy here of the US Bond Ag Index, and stocks, being the S&P 500, that US balanced investor finished down negative 16% last year. Third worst when we look at the last 70 years. So a very difficult year for any balanced investor. And a balanced investor would be anyone, in this case, that is somewhere approaching retirement or in retirement. Very difficult return sets for those. One of the bright spots, though, that produced only some of the only positive return sets in the market were the alternative asset classes or private investments that we make for our Westmount clients. Those being US core real estate finishing up 12.5%, or European core real estate finishing up 6.8%, or some infrastructure assets finishing up 5.6%. So there were some bright spots in the market, and those were not found in the public markets, but actually found in the private markets, where assets are appraised instead of marked daily in a market. So during that very difficult year, Lorenzo, why don't you tell us some of the things that actually worked out for the Westmount clients?
So as Matt mentioned, a big part of our philosophy with clients is complementing our clients' exposure to stocks and bonds with alternative investments in the same way that many institutional pension and endowment clients do. And we do that predominantly through the two funds that we created for our clients to simplify their exposure to private investments. One of the funds is the Westmount Alternative Income Fund. That is where we hold residential mortgages, commercial mortgages, private credit, and structured notes. In many ways, what we've done for our clients is taken a traditional bond exposure and split it into two, where clients will have some exposure to traditional bonds, and then we take some of that exposure that would have traditionally been in regular bonds, and we put it into these other types of income-producing investments. And we're very pleased that worked out because, as Matt showed us, fixed income had a very difficult year last year, but our Westmount Alternative Income Fund was able to return a positive return for clients of 0.3%. So relatively speaking, a very strong performance for investor. We also like to allow our clients exposure to private real estate, private infrastructure, and we do that through the Westmount Real Asset Fund. And again, that fund was up 9.3% last year. So we're very proud of the returns there. And our clients that are in our core model and our growth model sometimes have exposure to private equity as well. And we do that through an investment in Kensington's private equity fund, which also finished up the year with a positive return of 3.7% last year. So unlike a traditional balanced investor, most Westmount clients outperformed their various risk tolerances because of their exposure to alternative investments. The other thing that's important to note is that it's not just investing in an asset class that matters. It's important to think about the positioning within that asset class. So real estate can be thought of in different ways. There is apartment building exposure, there's industrial and warehousing exposure, there's owning office buildings or units, there's owning retail, real estate. And what we can see on the chart on the right-hand side is vacancy rates on US forms of real estate by property type over the last 20 some odd years. Obviously, you want to be investing ideally in forms of real estate which have low vacancies. And what you can see is that the two areas that tended to outperform last year in real estate were apartments or multifamily residential and industrial/warehousing. And we were able to get significant exposure to both through the Westmount Real Asset Fund through the holdings listed on the left-hand side. The other thing that worked well for us is our US currency hedging. Whenever we invest as portfolio managers in US equities, one decision we have to make is whether or not we're going to invest some, part, or none of that holding. Traditionally, our stance has been not to hedge our US dollar holdings. And the reason for that is that the US dollar tends to be the currency of safety when global markets are volatile. When people are fearful, they tend to buy US Treasury as kind of the safe asset. As Canadian investors, when we own US equity investments, when the equity markets go down, the value of those investments come down. But when the US dollar in that same period of time is rising relative to the Canadian dollar, it offsets some of that loss. And we can see that very clearly in the Vanguard US Total Market Index ETF, VUN, which is one of the holdings that almost all of our clients hold. You can see the unhedged return, which is what we hold for our clients, was down 14% last year, whereas the hedged return was down 20.8%. So that almost 7% outperformance came from a currency decision. It should also be noted, though, that in late summer, when we felt that the Canadian dollar and US dollar had hit probably one of the lower points of their exchange, we chose to layer on currency hedges on some of the US dollar denominated investments within the real asset fund. So we do take a tactical approach to currency at Westmount, and that certainly helped our investors last year, especially in their US equity holdings. The other thing that did well last year was our bond holdings. Now, obviously, when I say well, I mean relatively speaking. Everything was pointing south when it comes to bonds last year. But if you take a look at the index returns, which are the last three bars that Matt went over in a previous slide, you'll see that fixed income indexes were down on average down 9 to almost 12% last year. Our core main exposure in fixed income is the RBC Core Bond Pool. It was down almost 9%. So, relatively speaking, from a global bond perspective, did better than the index. And our actively managed fixed income position, the Lysander Canso Corporate Value Bond Fund, again, did significantly better than the index, down only 6.4%. So what are we excited about for 2023? Matt and I both believe that there's reason for optimism. Let me pass it over to Matt to walk us through it.
It was hard to be optimistic last year, but looking forward this year, there are some things that we'd like to highlight. And one of the biggest items we'd like to highlight is how US inflation looks like it has peaked last summer. So we've had 6 subsequent readings of decreasing inflation. Now it's still above that range that Lorenzo mentioned before of 2%, but it is heading in the right direction. And more importantly, what this will lead to is a change in central bank policy. So do we get a pause? Does that mean that the US Fed or the Bank of Canada stops increasing rates? Do we get a pivot, which means they actually turn and end up cutting rates? And that's what is shown in that graph below, where the dotted line is showing that the central bank may pivot later on during this year or in early 2024, or more likely than not, will they just increase at a smaller increment moving forward? Whether it's a pause, a pivot, or smaller increases moving forward, we believe that that will be positive for financial markets for 2023. The other thing that we're very excited about is China reopening. China, after 3 long years of being locked down through a zero COVID policy, is re-emerging. And really that's an important thing to note. We've got a large component of the global population now that will be able to spend, that will be able to travel, and all of those dollars will flow throughout the global economy. And that Chinese buyer is significant and would and could really lead to strong corporate profits. Finally, bonds. Sore part of a portfolio last year, but with that repricing due to the increase in interest rates, it looks like a quite attractive entry point for bond investors in 2023. Before, when you were investing in bonds, there really wasn't much of a return to be had because interest rates were so low. Now that we've had interest rates move up, you're now getting compensated to hold your fixed income, your bonds, because you're going to receive compensation through the interest received for holding that bond. So it looks like 2023 is setting up to be quite a good or positive year for the bond market. And finally, when you get a large retracement in financial markets, and in this case, we're going to reference the S&P 500, and we're going to look at a retracement of greater than 15%, there is a higher likelihood that the subsequent 1, 3, 5, or even 10-year rate of return will be higher. And it's simply just that when the market falls like it did last year, about 20%, the likelihood that it falls another 20% the subsequent year is actually lower than the probability that it'll go up. So just the fact that we had such a terrible 2022 could set up the markets to have quite a positive 2023. So when we've got a good setup for our equity side of the portfolio, a good entry point for bonds, and we will retain that private market exposure to help diversify the clients and smooth out the returns for 2023, it could be quite a good year for investors.
And that's it for our fourth quarter commentary and wrap up of 2022. As always, if you have any questions, please feel free to reach out. We're happy to hear from you. We'll see you next quarter.
Thank you.